So now we're going to talk about accounting concepts and conventions. These are assumptions that we make when we are doing accounting. Some of these assumptions are written and others of these assumptions are not written down. Okay? The first principle is what we call the accrual principle. Accrual concept, or the accrual principle. It says that accounting is not just based on cash. Instead, it is based on use. If I use an apartment and at the end of the month, the rent for the apartment is $1,200, I will record $1,200 regardless of whether I have paid the $1,200 or I haven't paid the $1,200. So accounting is based on use. Does that make sense? If you use a car, it depreciates. While you weren't paying, when you were driving the car, you weren't paying money. But we still record the use of the car. Does that make sense? So accounting is based on use, not just cash. That doesn't mean that we don't record cash. We do record cash, but if there is a use concept, it's going to trump cash. That's the accruals principle. Does that make sense? So because of the accruals principles, you may have like rents accrued, salaries accrued. These accrued things are liabilities. Right, so if you have worked for your company for 2 weeks but you have not yet been paid, the company is they owe you money, so they are supposed to record your salary expense along with the accrual or the liability that they owe you. Does that make sense? When we record an accrual, so for example, let's say I have worked, I'm going to be paid this Friday, okay? But I have worked for 2 weeks before I get paid. So the college is supposed to increase or debit salaries expense and credit accrued salaries. This is a liability that they owe me. So let's say they are going to pay me $1,000, for example. So they will credit and then they will debit 1,000. So the first one is always the debit and the second one is always the credit. Does that make sense? If you are not an accountant, you can say, well, I'm going to always put the credit in parentheses just so I can see. Those they should net to zero. This tells you about the double entry principle that we will go over, okay, very soon. The second concept of accounting that you should remember is what we call the business entity principle. The business entity principle or concept. Some people call it the economic entity principle. That means in accounting, you look at the transaction from the perspective of the business that you work for. Who do you work for? Bank of America, Mass Mutual, Prudential. What company do you work for? Price Waterhouse, EY. Do accounting from their perspective. Otherwise, you get yourself confused. So, for example, let's say that you work for Springfield College, and students paid you $100 million in endowment. All these students went out, they were very successful, and they gave Springfield College $100 million. Well, you have to increase your cash. The money came in, right? We call that a debit, because cash is an asset. If you increase cash, it's called a debit to cash or an increase in cash, right? What do we credit? Somebody will say it's revenue. No, it's not revenue, because we have to do some things to earn it. We're going to put that in other income or liability, a deferred revenue account. And then as we do stuff to earn it, we will bring it into revenue. Does that make sense? So in accounting, I'm looking at it from the perspective of what? Springfield College. But from the perspective of the alumni that gave money to Springfield College, their cash went down, right? So you have to always follow the business entity principle. And then there's a bunch of C's that you have to remember. The cost principle. That says that in accounting, we need to record most things at cost, especially the non-financial assets like buildings, computers, furniture, fixtures. We record them at the price at which you paid for it. Not the price that you could sell it for. The price that you could sell it for is what we call market price or fair value. Okay? We're going to get deeply into that. But most non-financial principles, most non-financial assets and liabilities are recorded at cost. This was true until maybe 2001, 2002, and then we have economists, we have finance people coming into account, and they said, no way. If you have financial assets like a bond or a stock, equity stock, why will you record it at cost? You have to record it at market price, the fair value, because this is how you could sell it for. It's very determinable and it's easy to see. People believe you more. It's more objective, right? So the cost principle is almost dying, but it's not dead. So in accounting, we use both cost and market price. When we do that, we call that a mixed attribute model. A mixed attribute model just means you are mixing cost with fair value or market price, okay? In general, non-financial assets and liabilities are recorded at cost, and financial assets and liabilities in general are reported at market price or fair value. That's not always true, but in general, that holds, okay? Now, the next principle is the principle of conservatism, also called prudence. That just means be wise, right? So in accounting, we use a lot of estimates and judgments. When we make a lot of estimates and judgment, we have to err on the side of caution. So we have certain unwritten principles. We don't write them down, but we know it in our head. If my estimate is for an asset, and the value of the asset could be 2 million or 1.5 million, this conservatism principle says, be smart. If you go tell people the value of the asset is 2 million and it is not, you're more likely to get in trouble. So why don't you use 1.5? You understand what I'm saying? So for an asset, you are more likely to understate rather than overstate an asset. In other words, bring down the good news and let people know the bad news first. Because if you don't let them know the bad news and you tell them all these fluffy, flowery stories, and it happens to be bad, they will be very upset at you. So for a liability, which tends to be a bad news, if you have the option to over or understate, you would overstate a liability. Does that make sense? Because you wouldn't show the bad news. These are things that we won't write them in a textbook for you, but that's stuff that is at the back of accountants. So we are very conservative or prudent. This principle is also dying because we have actuaries, we have finance people that came and say, no, this is not good news. You have to be neutral. You cannot be conservative. Instead, we want you to be objective and neutral. Tell me what the value is. Don't try to tell me whether it is low or high. Does that make sense? So this principle is also on its way of going down. Now, you could also look at consistency. Consistency means from one period to another versus comparability, meaning from one company to another, okay? Make sure you understand the difference between consistency and comparability. You have to stay consistent in using accounting principles from this year to next year to the following year. Be consistent, okay? That doesn't mean you can never change, but if you change, you have to explain why you are changing. So for example, if this furniture is worth $100,000, and you decided that you are going to use the straight line method of depreciation, that means you are going to take the furniture and divide it by, let's say, 10 years. Okay, $100,000 divided by 10, that means $10,000 a year. Does that make sense? Now, when we get to year 2, you say, no, I don't think the straight line method is good. I should have used the sum of years digits method, or I should have used the accelerated depreciation method. Now you want to change your mind. If you want to do that, you have to explain why are you trying to change your mind, and you have to get a letter of preferability from your auditors. You have to talk to your auditors and explain why you want to change your accounting method. So consistency doesn't mean you can never change. You just have to go through some hoops to change. Make sense? Comparability means comparing one company to another. Because if I don't compare my company to your company in the same industry, I might not be able to make intelligent judgments or understand the drivers or the dynamics of the business. So that's what comparability. So in accounting, we will normally ask you, what's the difference between consistency and comparability? One year to another year, one company to another company. Does that make sense? Okay, it's comparability. Now, double entry principle in accounting, every transaction that we record will have two sides, a debit and a credit. So when I pay cash, I will say my cash decreased, and you ask me, you paid cash for what? I paid it to buy a car, so my car increased. So in accounting, we record every transaction in two steps, debit and a credit. So if I say this increased, you're gonna ask me, where is the decrease? Because if I don't do debits and credits or increases and decreases, my balance sheet will never balance. The reason why the balance sheet balances is everything that I increase, I decrease something. So it keeps going on. It's a balancing scale. Does that make sense? That's what the double entry principle says. For every debit, there should be a credit, and for every credit, there should be a debit, okay? And then this is what we call the realization principle. Realization principle. It almost means when it became cash or when you earned it. To realize is for something to become cash. You sold some stuff on credit to people. Those people received the stuff, and then they came back and gave you cash, okay? So you have realized it because you've either received your cash or you delivered your services, you've earned it. You go to Walmart, you take a laptop, you bring it to your house, you pay for it. Has Walmart earned it? Yes, no? Yes, they have earned it because you took their laptop, right? Even though you haven't paid for it yet, they still have earned it. You will pay for it. They trust that you'll pay for it. So that's what I mean by earned. The word earned means that somebody has donated their blood, energy, sweat, giving you something of value. Does that make sense? And whether they have paid cash or not, if they pay cash, yes, it's still unrealized. If they gave you stuff and you promise them that you will pay, that's also earned. That's also good. Does that make sense? Realization. And then there's this principle of materiality. Materiality. Materiality means, does it make a difference in the decision making? Information is material if it makes a difference. In finance and accounting, we will say that information that makes a difference tends to be related to future cash flows. It tends to be incremental. It tends to make a difference. If you have big numbers, they tend to be material. They tend to be important versus small numbers, right? Things that will make an investor put their money in your company is material. If you go to court, will the judge consider this information in making a decision, a legal decision? That's material information. Any information that is important enough in your decision making, we are going to call it material. So materiality can be dollars and cents, we call that quantitative, or it could be qualitative. It could be something that is a description. Does that make sense? Materiality. These accounting principles that I'm sharing with you keeps on changing. Now, we talk about representational faithfulness. Representational faithfulness. Instead of reliability versus reliability. If I say the word reliable, some people think, oh, reliable means, well, it's 100% true and all of that. No, that's not what it means. We want you to tell us information that is a faithful representation. It's the truth based on all that you know. Doesn't necessarily have to be reliable. So we kill reliability and we put in representational faithfulness. Does that make sense? Or faithful representation. You will hear that. And then also think about objectivity. Objective, you have to be objective instead of subjective. Use information that most people know to be true. Don't make up your own numbers, for example. Does that make sense? Okay. And we already talked about materiality, which is very important. And then another one you have to remember is relevance. Relevance. What does relevance mean? When we say something is relevant, it means it's material. But it also means somebody can rely on that information to make decisions externally. So materiality is just a subset of relevance. Does that make sense? All right? So these are the accounting principles that I want you to be aware of. More importantly, materiality, relevance, faithful representation, and those things. these other things that you learn here will also help you. With that, let me take a